Thank you very much. Okay, so I'm super happy to introduce our two speakers today. So we have Bev Shah. So Bev is the founder of the City Hive. She worked for 15 years in financial services. She's a big advocate for diversity in asset management, in investment management, and she can explain you what this means and what are these industries. And last week you opened the London Stock Exchange, which is the coolest thing on earth if you work in finance. So, yeah. So you can tell us more about that. And there's Laura Whateley. So Laura is a journalist from The Times and now writing for a lot of other magazines. And she's also an author of this beautiful book called Money, a User's Guide. And we'll do a giveaway at the end, so you have a chance to win Laura's book. So these are two real money gurus. So we'll have a nice conversation about money for 45 minutes. And then if you have any questions, you can ask us anything after the session. So, Bev, can you start and tell us a little bit more about yourself?
This one? Yes, so I started in the city actually 2 decades ago, my first role at Lehman Brothers as an intern.
Oh, like me?
Yeah, it's no longer around. And then I went to Bear Stearns, and that's no longer around. I don't know if that's a trend. HSBC is still here, though, so that's not me. But actually, I fell in love with the idea of investing when I was a teenager and watched Trading Places and became obsessed with the idea of shorting orange juice futures, and I couldn't quite understand the swaps and the options, and just the whole idea of the open outcry market. I know it's very male dominated, but it was just something that I really just loved the idea of. So very fortunate to have fallen into banking at the time. I thought I was very lucky anyway. And my first proper job out of university was as a trader at Bear Stearns. I hated it. It was like, I don't know, you climb up a mountain and you look out and there's no view. It was just, soulless, misogynistic. I found myself, I turned into kind of a sailor. I swore at anything and everything. I lived at home with my parents for a bit. And my mother would ask me what I wanted for dinner, and I'd be like, I don't fucking know. And she'd be like, I didn't raise you to talk like that. You just end up being forced to be like everyone around you, because obviously 20 years ago, being a woman in the city was not the norm. And then I thankfully fell out of the bank very quickly into my career and fell into the asset and investment management world, which is completely different to financial services. Financial services is a PR term for banking. After the 2008 crash, it was a nice way to make everyone feel okay with the politics of hate around banking. So all the comms people said, right, let's call it something else. But investment management is a completely different thing. Money is different to investing, and that's the industry that I fell into.
Yeah. So asset management, investment management is more investing people's money.
Yeah. So when you put your money into the pension, we're the ones that will manage it for you. That's the bit that confuses everyone.
Hi. So I'm Laura. I find it quite funny that I'm referred to as a money guru because I've actually never been particularly brilliant with my own money, which I've come to realise makes me sort of a useful communicator about money because I do understand the challenges. I started working as a journalist 10 years ago, so I'm 33 now. I was 23 at the time. I just graduated and I wanted to be a journalist. I was quite interested in social affairs. I was doing work experience at the Times and found out about a junior position at the money desk, and the person I was doing work experience at the time said, oh, you should apply. And it felt like a bit of a joke at the time because I was awful with money, but I thought, oh, it's an opportunity to get into journalism, I'll give it a go. So I was up the night before Wikipediaing what is a mortgage. It was a very junior role. There was a lot of admin involved, but I ended up staying there for a very long time. I've been writing for the money section ever since. But it was, interestingly, at the time, about 2 weeks or so, my interview after Lehman Brothers had collapsed. So I realised it was a very, very interesting time to start learning and writing about money because it was affecting everybody's lives. And personal finance, although it has a bit of a reputation as being quite unsexy and quite dry, actually is very, kind of underpins everything that we are able to do. But I still think it's something that people are very frightened of. So anyway, over the last 10 years, I've been writing about money and various other things, and realised that a lot of the people I'm writing for who read the money sections of the newspapers are people who are already quite confident about their finances and understand money. And a lot of my friends had never really read anything that I'd written, because they felt that the money section wasn't for them. So part of the reason for writing the book was to try and communicate all this stuff that I'd learnt writing about money, but also in my own life and trying to navigate my 20s in London as life has become increasingly expensive, and create something that, and sort of communicate what is a mortgage, what is a pension, what is investment to a lot of people who are otherwise super educated and smart and switched on, but have this blind spot about money because we never really learned about it in school. And I think people are quite embarrassed to admit what they don't know about personal finance. So now I'm on a kind of mission a little bit to communicate, I guess, about money, make people feel a bit better and a bit more confident about talking about it, particularly young women.
Yeah, I think it's a lot also around, the jargon and then the vocabulary you use around finance. So personally, I studied economics, I studied management, I worked for Lehman Brothers, I worked in private equity, but even then I wasn't proactively managing my own finances, because even within the banks there's a massive knowledge gap. You realize between people working in corporate finance, so looking at how businesses actually work. So when you work in banking and you earn a lot of money, I guess it's less of an issue, because you'll always find a way to bridge your own finances and have enough money at the end of the month. But you realize you're not making smart financial choices for yourself. I
was just going to add, I think that's really interesting, because I think lots of people approach me and say, I'm terrible with money. But if you've got lots of money, it's easier to hide that. So I think if you see your friends earning loads of money, or they seem sorted, they aren't necessarily. It's just if you earn plenty of money, or you're quite well off, or you have money from your mum and dad, it's easier to hide the financial mistakes that you make.
Yeah.
It's kind of absolute and relative, isn't it? So if you don't have enough to get to the end of the month, you're not going to do anything with it. But I've worked at the city for 20 years, and I'm awful with my financial health. I sit in cash, which I shouldn't do, because I manage portfolios for people, multi-asset, so I understand the asset classes, I understand that. I don't understand the product side. I am useless if someone asks me about pensions. I understand the concept and what they're meant to do, but the regulations around them change so often. We were at a similar event recently all three of us were, to do with the gender pension gap. And I didn't realise that I could take some of my husband's pension allowance and that could come to me, and there's, but then I was just like, that's too complicated, I can't deal with this, even though children born today have a life expectancy of 100, right? So there's some academic research around this done by, I think it was the LSE, and there's a book called 100-Year Life, and it looks at, we now all have to think about more than just having a cradle-to-grave career. We aren't all going to be in the same job. Companies, I'm sorry, but anyone who trusts their company, no, they don't care. I'm sorry, but they don't. The company culture has gone wrong, and they will make you redundant like that. All the extracurricular stuff they do for you, you do for them for nothing. You think they're going to look after you because it's a machine. It's not a real human being looking after you. So that reality is gone, and so we all have to think about different types of careers. People are moving more towards freelancing and portfolio careers, working for different companies as opposed to staying in one. Final. Does anyone know what a final salary pension is? That's where they would pay you a portion of your salary when you retire. It's a dream. My husband, because I'm old enough to know about this, my husband has one.
Really?
Yes. He wasn't at the company for long enough. He was there for a long time though, but that's just crazy. But the thing is, he doesn't understand what he has. He works in the city. I'm like, you have a unicorn, So it's so important to kind of just, you've got the product side, the money side, go into the pension, and then you've got a whole other gambit of investments, which is another completely different.
So how do you, I mean, what's your story with money? Because I guess you worked in banking, now you have your own business. So that's like also a massive difference in terms of income. So how do you manage your finances today, like trying, build a business with your family?
I think I'm lucky that I'm older. I don't have the same challenges that young people today have. That sounds so patronising. I'm really sorry. But if I feel grateful that when I started, I could buy a house in London if I wanted to for £180,000, and I could get a mortgage on one salary to do that. And I didn't earn a massive fortune, even though I worked for a bank. I earned it in dollars, and it was half because the currency was awful at the time, and it's awful again now. So so I'm that kind of generation where I got on the housing ladder before everything started to go wrong. I mean, I'm not one of those people who has lots of houses, by the way, and rents out. I just have one house, and I'm just past that time. So I got a lump of money from inheritance. So I'm trying to do some good with that. But yeah, I don't have a salary. So I don't do the things I used to do, but I've never liked expensive clothes. So I don't really bother me.
And you, Laura, I know you tell your story in the book, but
about what? Yeah, so I'm freelance. I've been freelance about 5 years now, but before that, I don't know if anybody here works in media, but it's a funny old world of dodgy, not really staff jobs. So I had a job without a pension, and I was paid a day rate for many years. So I've never had a company pension, for example. I've always had to try and figure things out a little bit for myself. So I was really lucky. Like Bev said, it's been really, really challenging to buy a house, as we all know, especially in London, because the amount of money that we earn is much less than it was for people of our age before the financial crisis, I say our age, people in their 20s and 30s, which I think is quite interesting. And people who've earned their first sort of wage packet like me since the financial crisis, our wages haven't been going up very fast, and yet house prices have, or they have remained very high. So the amount that you can borrow in a mortgage is only a maximum about 5.5 times your income, maybe much less than that. So if you look at the cost of house prices versus how much you can actually borrow, that's what the real challenge is, not that we're overspending lots. But as I write in the book, I met my now husband when I was 23, a baby. And his dad died when he was young and left him some money to inherit when he was 25. So we'd already rented together for a year. So when he was 25, when we were both about 25, we had this really difficult discussion. I'm like, okay, how's this going to work? I've got no money, I've got an overdraft. You've got this money to buy a flat in London. So he bought a flat, and I lived in it until 2017, and that enabled me to save money towards buying a flat together, which we bought a year and a half ago. So I'm really lucky that I'm on the housing ladder, but that doesn't mean that I don't have that challenge of trying to find enough money while renting to buy a house. But I'm not I'm trying really hard to save for other things. I don't have hardly any pension. I realise I've had to start one recently, which is embarrassing to admit, but it hasn't been a financial priority for me because I wanted to get on the housing ladder. And I think we were talking about this earlier, but I think one of the challenges for the financial services industry is that still people at the top are older men who are making decisions about financial products. And I think there are challenges for younger women about how you think about money, and I'm in a process of thinking I'd like to have a family, so I need to make sure I'm saving for that, but I'm also having to save for my tax bill, and I'm also worried about employment. So why would I want to lock my money away in investments and pensions?
Yeah, and I think one difference between men and women, and you touched on this, is men tend to invest more for the products and for the financial return, and women would look towards, achieving our financial goals, so like protecting our family, reinvesting in our peers, investing in like women businesses. But Bev, that's a subject that, you're like a massive ambassador. You're the City Fearless girl. So what's the City Hive? What do you do?
So we're changing. I love it. The BBC call us change agents. That makes me feel like a Charlie's Angel. We're changing for cultural change. So through my career, and because what I used to do actually for the majority of my career was pick fund managers. I used to research and meet some of the best investment minds in the industry. I mean, thousands and thousands of them. And I worked for a big firm, so we had a lot of money under management, I think something like 90 billion. And so, doors opened for you. But
just investment managers are professional people working in finance and in investment, so they collect all your money and they will decide how they invest it for you. So they will invest it in like shares, bonds or funds, and they will try to get you the best return for your money, and you pay them usually a hefty fee.
Some hefty, some not so.
Some
There's a
not
big
so.
debate on that. But yes, the problem is that people think it's a science, but it's an art. The city loves numbers, but actually numbers look backwards. You need to look forwards. It's EQ should be looked at, not IQ. So we're trying to change the culture because from my own experience, I'm an expert in this, and I know it's cognitive diversity you want. Who would you rather have manage your money? Would you want a table, would you want people around the table who all look the same, who come from the same experiences, so they think the same? Or would you rather have people who kind of look different but come from different backgrounds with different biases and different beliefs, who when everyone's looking in that direction, someone's going, hey guys, have you seen that? And that's why we had the crash in 2008, because everyone is looking in that direction. And all you have to do, you don't have to be a finance person, just watch the film The Big Short. In that film, it outlines what happened. The people who made money out of the crash were the ones who were different. There was the Christian Bale character who was on the spectrum, he's autistic. I've met many fund manager who is on the spectrum, and they are by far some of the best fund managers I know. They don't present well, but they think in a different way. That's cognitive diversity, and that's what you look for. That's why, so you outlined earlier, one of the reasons you want more women in the city is because it reflects the client base. The other reason is cognitive diversity. Why don't we think differently? People are trying to, the whole movement tries to make us into men, dress like a man, act like a man, then you can have a man's job. No, I bring something else to the table. I'm different. I'm just going to tell you this story because I always love telling it. I was on a panel recently with a very senior man in the city who's the global head of something. I'm going to say what, because then you might be able to find who it is. And he, into a room full of white male wealth managers, said, we were debating the idea of cognitive diversity and women and what we add to the table in investments. And he said something like, really patronising, and let's be clear, gentlemen, we fought very long and hard to show that women's brains are equal to men's brains. At which point I wanted to go like this. Right? I wanted to punch him in the head. At which point I did what every good panelist does. Thank you very much, but... and I said to him, yes, our brains are equal to you, but our bodies and our hormones and our experiences are completely different. From the moment you're born as a woman, we experience something completely different, not just from your environment, but from everything. I have a 6-year-old who's a boy and a 4-year-old who's a girl, and I can see who's the winner out of the two of them. And I can tell you it's not the older one. There is a hormonal thing. I can grow babies inside now. I can do things. Women can do things men can't. It's not about strength. It's about our differences and appreciating them and having the same opportunity. And that's what the city or a lot of male-dominated environments have not opened up to. The internet is the same. It's male. Coding is male because it's all men. It's not an evil conspiracy, but that's how the world has gone. I mean, you couldn't go onto the stock exchange until women couldn't go onto the London Stock Exchange until 1973. So the journey's just started. We're at the tip of it, right? Some of you were just born after that. I was born 5 years after that. It's not, it's the start of the journey. Yeah. But in the city, sorry for hogging it. I told you I'd hog the mic. But going back to your point about it being men at the top, the language is all male because that's who initially they were selling to. Anyone in marketing knows the kind of marketing 101 of this is Tom, this is who is our client, this is who we sell to, right? They've never gone, this is Barbara, and this is Rena, and this is, whoever. They've not done that. And the language is the same. And then when they get guidance from other outside organizations, like, I don't know, the other bodies, I'm not going to name them, but other industry bodies, you go, you need to change your language. Again, it's coming from white men going, you need to change your language and you need to do this. No. You've given one set of guidance and you're dumbing it down and you're using the word millennial. It's like you don't know what you're doing, and what they don't realise is the wealth transfer that's happening. We both alluded to inheritance. In the next 10 years, the wealth transfer through inheritance means the majority of the wealth in the world is going to sit in the laps of women. Now, big financial companies, if they don't wake up to it, small ones as well, are going to miss out, because then you've got women like us, you've got a whole movement of women who are going, screw this, I'm going to set my own business up. I'm going to do this for the girls. And those big guys are going to go away. But we have the power now. And they don't, and we just have to realise we do.
No, exactly.
Sorry,
and there's more. No, and you're right. There's more. So there's more senior in women in senior positions. There's more women funding businesses, but it's still extremely hard for women to raise funding because the money still hasn't changed hands still, and women are still a bit more skeptical into going into investing. I think. And that's maybe our next subject is women are really good savers, and we are on paper really good investors, and research is showing that. But practically, there's a very small number of women investing money. So how can we change that, and how can we learn more about our own personal finances and potentially get started to also make our money work? Because as we know, inflation is relatively low at the moment, is around 2%. But if you have money saved on like cash accounts, it pays you 1%. So over a year, it's okay. Over 10 years, over 20 years, it's not okay actually. So we need to make this money work. But since there's this barrier of how do I work with an advisor? There's only 15% of financial advisors who are women. I found it really hard actually to find a point of contact to get started in this industry. So how do you get started, like actively managing your finances and then going into like investing and maybe property or the stock market?
I don't know how many people invest in stocks and shares here. Anybody? Oh, loads. Amazing. When I was doing research for the book, I asked a lot of my friends and family whether they invested, and they all laughed at me, because I think there's still a perception among people perhaps who don't work in finance or who just, perhaps aren't particularly confident that investment is still attached to people who work in the city, Wolf of Wall Street. It's very risky. And I think there's a big lack of financial education, which makes it feel very overwhelming. I don't know a huge amount about investment. I know the basics, but I think it's one of those things, certainly before I wrote about money, that I just found completely overwhelming and impenetrable. And I know, people have pensions because they're auto-enrolled into a pension scheme with their work now, but they don't know the first thing about where that pension is or what it's doing. I asked my sister the other day, who's a few years younger than me, I was doing something on pensions and said to her, and I think it's quite telling, I've never actually had this conversation with her before. Do you have a pension? Yes, through her work. Do you know what it is? Something to do with saving for retirement? Do you know where it is, what it's doing? And she didn't really have any idea, and she was very embarrassed about this. So I think there is probably a lack of understanding and knowledge, and I've talked about this before. I don't like to generalise, because I don't think all women and all men are the same, but I think there probably is a bit of a pattern where maybe women are more hesitant to do things they don't understand, whereas maybe, and it might not be inherent, it might just be the way we've been brought up, but I think there's guys who probably invest who don't understand any more than women do, but they do it anyway. They just think, I'll give it a go.
Yes, there's a lot of research on this, and it comes down to your attitude to risk. If you just look at the demographic of people who walk into a betting shop, I don't think there's many double X chromosomes walking in. There are, of course, but there's a generalization for a reason. It's about risk taking. So for me, when you invest, and this is throughout my career, it didn't matter how big the portfolio was. I've worked for individual private clients, and I've done the big multi-asset portfolios. It doesn't matter. As far as I'm concerned, I want to manage money like I would manage my own and look after my own, and because it all trickles down to, and in the city we love using the analogy of Mrs. Miggins and Joe Taxi Driver. It doesn't matter whose money it is and whether you're in a big institution or you're a trustee on a pension fund. All that money trickles down to regular people, someone's hard-earned cash, and you have to remember that. So if you're doing it for yourself, so it's about your attitude to risk and what you're willing to risk. So for me personally, when I invested, I didn't care about the. There's lots of like fancy ratios you can look at. You know, lots of stats that they give you for volatility and, you know, the standard deviation for this and that. For me, it wasn't that. It's like, am I going to lose money from my client? That's the biggest thing. It's not about what it is pegged against. For me, anyway, it was never about what it's pegged against, what the FTSE's doing. Am I going to beat the FTSE or not beat it? Because actually, if the FTSE drops, you know, 10, 20%, and I only dropped 15, and my fund manager tells me we're up 5 relative to the market, yeah, but I still lost 15. Yeah. I don't want to lose anything. And then, you know, so that for me is if you kind of have someone investing for you who understands that it's your hard-earned money and they need to treat it like their own. Maybe not even their own, maybe their mums, you know, someone who they're looking after. That's what it's about. So for you, as an individual, it's not, because then you're adding another layer, and let's go and find an advisor. And then do I trust that person? Do they know what they're doing? The main thing is there is information out there. And it's educating yourself. And if you don't understand it, just take the baby steps. So the idea around funds, for instance, it's you've got it spread across. You're not just picking an individual stock. Because if you buy an individual stock, for instance, so I don't know, you buy Shell, what you're doing is you're kind of making a massive bet just on one company, on one sector, and there's lots of things around that will be pulling it in different directions that professional investors know about and that you don't. Some because they will be behaving in certain ways, and institutional investors will do things that you don't know about because they, you know, that's what we do. We understand it. We look at charts and things. So if you invest in a fund, you're kind of spreading the risk. And then you've got the choice between an active fund, which is someone who on a daily basis looks at it, hopefully doesn't trade it on a daily basis. You want someone who's going to take a long-term view. But someone who's actively looking at it, they won't buy every stock in the FTSE, but they'll buy a handful, cross it, and look at all the fancy numbers and tell you, you know, this is going to be all right. And then you've got the other option of a passive fund, which basically just tracks what that index is doing. Those are very simple tools that you can use and go into on day one if you want to. But it's a risk. You've got to understand the risk first. But don't be scared because, like you said, there's inflation that you're fighting against. If you leave it in the bank, when you retire in 20 years, that's not going to be worth the same, right? You know, and it's going to be worth, and God knows what's going to happen with inflation now. You know, and actually for me, I'm actually looking at this time of uncertainty as a time to invest. Because I've got 20 years until I retire, or maybe earlier, but 20 years till I can touch it. That's long enough for there to be up, down, up, down. So I'm not going to worry about it in 5 years if we have another crash, because I'm not going to touch it for 15. And that's the other thing. If you put it into the market today, if you're not going to touch it for 40 years, it doesn't matter, because it's going to do that.
And we've seen it with the Lehman bankruptcy 2008, and the market has fully recovered from the losses.
And it doesn't have to be thousands.
10 years ago.
We're talking about actually if you're a young person who doesn't have much, we're talking 25 quid a month. Yeah. Compounding is a very powerful tool. You keep adding and it keeps going up. It's very powerful. And before you know it, you're like that money. We were talking about that app, Moneybox. Amazing. End of the year, a friend of mine did it. He had £2,000 in it at the end of the year. All I said to him is, how much coffee are you drinking to kind of... Yeah.
So Moneybox is an app that's rounding up your savings. So let's say you buy a coffee for like £2.50. It will round up your purchase to £3, and it will add this 50p into an investment account. And Moneybox, they're collecting a lot of money from, I think they have 160,000 investors. And they're collecting all this money and they're investing in a portfolio of passive funds. And you pay them a fee for that. But basically, without realizing, you're starting to invest some money. So that's maybe like the base option to try to learn a bit more about investing. And they're called a robo-advisor, but they're like a small robo-advisor. And then you can move up the chain, and then you have the bigger robo-advisors, and you can invest from, I think, £25 a month. And you have platforms such as, Nutmeg, Money Farm, Wealthsimple, Wealthify, and all these guys, same thing, they will do all the investing for you. So if you're not too sure about risk, because risk-reward, there's a relationship between, how much risk you want to take, and usually the more risk you want to take, you should be compensated for this risk. So it doesn't mean you're guaranteed to get a better return, but usually you should get a better return. So when you go on these platforms, they will ask you a few questions about your appetite for risk, like how would you feel if, the market goes down 10% tomorrow and you lose all this money. So some people will feel okay because they want to take the risk, or they will be like, oh no, I'm out of the market. So once they understand who you are as an investor, they will build this portfolio for you and they will do the investing for you. And that's a good way to start learning. And after this, then you can move again and go for more a DIY option. And there's a lot of fund supermarkets where you can go and pick your own funds, pick your own shares. But then you need to be, quite a more advanced investor. That's personally what I've been doing. So it's not always working, but at least I'm in the market. And I think the main thing with investing, and I say it super often, is get started, because you can learn as much as you want about investing. You're never going to be 100% sure about what you're doing. But, even £25, £100, £1,000, when you have this in the market and you see market fluctuations, then you realize what investing really is.
I think some of the apps are a bit scary, though. I was talking about this the other day, because as I understand it, part of the thing that you should do to reduce your risk is try and invest and kind of leave it there and don't fiddle around with it too much and don't freak out when the market falls. But apps encourage you to look at it all the time, don't they? So I think that's quite dangerous. That I met someone the other week who said she used Moneybox, but then saw that her money was losing money and took it out because she got cold feet, which is the worst thing that you can do. Like we were saying, after the financial crisis, if you've got cold feet and take your money out, you would have lost a huge amount of money. But if you'd had the guts to sort of stick in there for another decade, or you would have made money.
Yeah, so there is a difference in the way people invest. Not just people, but if you look at institutional professionals, the way a hedge fund, so if anyone's watched Billions, hedge funds, or a bank, an investment bank, a trader in a bank would invest, is completely different. It's fairly short term. It is looking at the charts. It is, buy low, sell high, do it today, trade. An investment management company would do it completely different. They call that fundamental investing. So what you would do would actually be, I want to invest in this company, but I'm going to go and meet the company management. I'm going to go and visit that factory. I'm going to look at your company report, your accounts over the last few years. And I'm going to make the decision to invest in this share because I believe that there's an investment story and an investment case to hold this for the next 3 years. And whatever happens, I believe that this company is going to do better. And that's what a active manager would do in the fund. They're not trading on a kind of really quick, every day, no, the stock's gone up and down. That's the difference. So I think some of these apps are turning people into kind of day traders, which is a completely different thing. It's looking at charts. I mean, there's no science to that. That's just literally just, I'm sorry, I'm going to be shot after this. Someone's going to come and kill me. But that is just throwing a dart. I mean, there's a perception that investing is a science. And honestly, it's not. It is an art. It's a human being going, I think that's a good idea. It's very subjective. It's taking your own experiences. And as an individual people, you have the same skills. It's just having that belief that you trust yourself. And while, we all look at our own health, our personal health, our financial health is just as important. That's the education piece about, actually the importance of it, not being scared.
Yeah. So Laura, in your book, actually, financial health is really a big topic. So what really made a difference for you in terms of managing your finances, like on a day-to-day basis? Is it budgeting? Is it financial goals? Is it talking to an advisor? What are the most important things for you?
For me, it's definitely looking at my bank balance, which sounds so silly, doesn't it? But there are a lot of people who don't look at their bank balance very often. And there's been loads of really interesting features recently about millennial burnout and how we're pulled in so many directions and just scrolling through Instagram the whole time, and our brains are full of stuff that we should do. And I think money becomes pushed to one side often because it feels horrible to address your finances, and also all these things we should do, like look at where our pension's invested or make sure that we're on the best mobile phone deal. All of these things that we know are sensible are not very fun ways to spend our weekend. But I think I often find with my own finances that when I'm short of time, I waste a lot of money because I know that I'm just not paying attention to where it's going, or I'm spending too much money on Ubers or takeaways. So for me, I think concentrating more on exactly where I'm spending and paying attention to that. I would say my biggest financial mistake is not doing that for years and years and just ignoring it and being too busy to care. I have various different bank accounts, and I talked about my husband earlier and how we've sort of sorted out our finances, but I think talking to him and sitting down and working out exactly how much we want to save, how much I want to save, how much I feel that I can earn to live on. I mean, I'm slightly different because I'm freelance, so I have that constant battle between, you know, I'm paid per article or per whatever it is that I do. So how much do I have to earn in order to get by in London, and how much do I want to earn? And is there somewhere in between those two things? And there's a balance between living a great life and earning plenty versus not working the whole time. I have various bank accounts to help with that. So I work out how much I want to save, and I have Starling and Monzo, which I find extremely useful to just track spending and put money aside. I pay myself first. I have my own money, and we have a joint account.
I love that, the trainer wheels joint account. It's interesting to hear you say that, because I went through all of that with my husband when we first got married, and now we have 2 kids, and we now have 100% joint finances. There isn't a single, actually where we have a joint account, everything's merged. I can move money around, and he doesn't, he probably doesn't even know. I had a conversation with him about 10 years ago, having heard some men in the city talking about how their wives don't know what they earn, and they have a secret bank account, which their wife thinks that's the money. And I just said to my husband, if I ever find out you've squirreled money, that's my red line. But what the last few years since having kids has got me thinking about is our as women, our position in society, and how relationships work, and how companies are set up with the white men at the top. Because there is an economic theory around the marriage model, for instance. Like in the 1950s, it used to be known as the factory model. The woman at home, which is the factory, and the management, which is the man. And that is why we saw a rise in kind of divorce rates when men retired and came home, and after 30 years of marriage, there's lots of divorces because they don't know how to live together. And then fast forward in a couple of decades, and then you've got to the position of 2 professionals who go out with each other, and they realise actually they like their company, and they'd rather pay someone to come and do the cleaning and do the other stuff, and that's fine. What no one talked to me, certainly, about when I was going through university and my parents were saying, go out there, you can do anything you want, you can be anything you want. No one told me what was going to happen when I uttered the words, I'm pregnant, in the office. Actually, I didn't even have to utter. I just said, I don't want a glass of wine, and everyone went, she's pregnant. So I don't know why. But I saw a whole shift in attitude. I saw my income go down all of a sudden because opportunities went away. I was already underpaid anyway, because I'm sorry, there is a myth around equal pay. I don't care what the law says. If your contract tells you can't talk about your salary, how do you know? There's all these things that are up against us. We already know we're paid less. We already know all this. So when you're in a relationship, and, obviously the modern way of doing things has changed slightly, but for instance, for me, when I'm in a traditional marriage, I've given up a lot. I gave up my career to, because I was the support network home. I have to manage the house. I have to manage the kids. And as much as there's a lot of talk about shared parental, we aren't there yet. We aren't there yet, because my husband's generation certainly are still that generation who had a mother at home in that tradition. So changing the mindset, and that's what you've got. You've got the men at the top who have the wife at home and the support network, and yet we're the generation that actually don't have that, because you need 2 salaries for a mortgage now. And if you're not getting paid the same, regardless if you're freelance or not, but then later on in your relationship, if you decide to have children or those sorts of things, those are challenges that financially impact massively. And all of a sudden it hits you, not from many angles, because no one tells you this. So it's things that might be a second book for you, by the way. It's things that's all linked to society. And again, that means if as women, if you don't save, there is a point when your pension drops off and all the rest of it. So
yeah, and I think there's this difficult conversation around childcare. So, same, I stopped working. I'm now freelancing or trying to build a business, or like no income. And when you look at childcare is extremely expensive, and women tend to look at childcare from their own perspective only. So how much do I earn, and how much does childcare cost? Can I afford it? But I don't think it's actually the conversation. I think it's like both of you, and you decide together, how much are we earning together? Maybe, I'm earning less, and that's okay. Can we together pay for childcare so that you or your partner can still stay employed? I mean, even if it's part-time or whatever, that's like a personal decision, but that shouldn't be like a financial decision to just give up working to, stay with your children if you want to keep working. And one point on pension, actually, and that's something I discuss very openly with my husband, is, I'm building my business and I'm spending much time at home, like more time at home, more time with the kids. So I can't afford to pay into my pension. And actually your partner can pay into your pension. So he's now paying into my pension, which is great. And that will, with interest compounding and stuff, it is super important that your early years, so between 25, 35, you actually top up your pension. Topping up your pension at 50, it's not going to make a huge difference. So even if you top up a little bit and, you can get some help, I think it's, even if you don't work, you can put £2,800 in a pension, and that's already like a massive gift. So I think it's super important to talk about money. So Laura, how did you start like talking about money? What was the trigger? Because in some relationship, I think, I'm married now, I have kids, so you have to face this thing of money, you have to pay for a lot of stuff together. But I think when you're in a relationship and not necessarily married, it's a difficult first conversation to have.
Yeah, definitely. I was forced into it because at 25, my boyfriend wanted to buy a flat, so we had to talk about it. I was lucky; he's very open about it and relaxed about it. But there's so much emotion attached to money, isn't there? And for him, this money was from his dad who had died. It was there's a huge amount of responsibility and sense that he needs to do something sensible with it. I mean, I'm very lucky that his mum has always been super generous and welcoming to me, so it wasn't a kind of, who's this girl you're moving in with? Is she going to try and steal your cash? But no, I write about this a bit in the book. There's a really awful survey by NFU Mutual that said it was some percentage of the bank of mum and dad who don't trust their children's partner and think that they're money grabbing or greedy. But it's really tough because, as you said, now I look at my parents' generation, and as you said, you could buy you obviously had a good salary, but you could buy a property in London on one wasn't that good, on one salary. But that's very, very difficult now because of this the difference between how much you can borrow and your income. So people need, certainly in the London South East, 2 salaries often in order to get a mortgage and then pay it. So you've got this issue when you're having a child, especially, me and my husband earn similar money at the moment, but I'm very conscious that what is going to happen if we do have a child. And you were saying childcare, I think, is still very much pitched as a women's issue, a women's problem, something that we have to think about rather than it being a kind of societal issue or something that we should all share. And I'm just going to quickly say about shared parental leave. I think this is a big issue. So you can now share your parental leave, but there are a lot of organisations. So the take-up has been extremely small. Now there's lots of think pieces about why this might be, and is it just because only women want to look after babies? But the truth is, it doesn't make a lot of...
My husband would love it, actually.
It doesn't make a lot of financial sense. I mean, there's lots of cultural things attached to it, of course, but it doesn't make a lot of financial sense for a couple. If you're like, right, we need as maximum income between us to pay for this flat and sort out childcare and all the rest of it. If a lot of companies won't offer their male staff a particularly generous package in the way they would their female staff, so actually you might end up taking maternity leave and get quite a good deal. I've seen this with a few friends who've had children recently. They said, well, it doesn't make any sense financially for the husband to take the time off because he needs his full salary. So I think that's something that needs to be addressed.
Yeah, it's that whole thing of if we know that men are getting paid more relative to the woman doing the same job, why would you take the cut from, say, the maternity pay? There's also the whole journey of having kids, right? So if you are going to take the maternity leave, you, as a woman, you're probably going to take, even if you're sharing it, the first bit. The man's career doesn't get a break, so it's a bit unusual for him to come out of it. And it does fall on the woman because it's the opportunity cost that's looked at in a relationship, right? And his journey hasn't broken, his path hasn't broken, his sleep might have done, but the rest of it hasn't. And so it's a bit more difficult than just saying you should look at it this way. But there's things that the government have done which have kind of made it even more difficult. So I don't know if many people have had to do childcare, but we've looked at all options and done all options. So nursery and childminders come out of your net salary. So after you've paid tax, you just pay it, and it's as a service. However, if you hire a nanny, you're her employer. So therefore, you not only pay for her pension contribution, although in my experience, most nannies don't take that up because it's then taking money out of their very meagre salary. So they don't earn a lot. It's not a very valued role, but it comes out of your net salary as well. You're kind of double taxing because you're paying their tax, you're paying their salary out of your already tax. It's not tax deductible. However, if you have staff, not that I have staff, but if you're a family that has staff, if you have a chauffeur or a cook, that's tax deductible, but your childcarer isn't. And so that's something the government should do. They should make, if you're going to have a nanny, it should be tax deductible because you're getting double tax. So it's the case in a few
countries actually. Yeah.
You could have had an extremely high salary and all your money would end up because you're being double taxed there.
So I'm just conscious of time. There's one thing I wanted to cover. So for one question for each of you, and then maybe a last tip or advice. So Laura, I just wanted to ask you, what has been your experience? So writing about a book, being sort of the face of money, being out there, because 10 years like writing about money and now a book, and I see you everywhere talking about money. So what has been your experience with that? And Bev, what happened last week? So can you tell us a bit more about opening the London Stock Exchange, because I think it's really, really cool.
One thing that I think has been really interesting is that I feel quite weirdly imposter syndrome-y about being a money expert, because I don't have any qualifications, I don't understand so much about finance, but I'm just holding on to the fact that I think this is quite a universal feeling, and I think leaving money and finance up to only people who feel super confident about it and like think about graphs in their sleep and like love reading terms and conditions is quite dangerous, because we all have money, and I think it's important to just try and discuss it as much as we can. I still find it a subject that is difficult to talk about with people that I am close to, so I don't really talk about it with my friends that much, partly because it now feels a bit like work, but I don't really talk about it with my parents that much. I would say I think it feels like a funny taboo subject. I'm really close to my aunt, who's my godmother, and when I got married, she helped me choose some wine, and she bought it so basically I owed her £200, and I forgot to pay it to her. So we went for dinner, and she suddenly looked really, really, really grave, and I burst into tears. So oh my God, what's the matter? It was really unexpected. I thought she was going to tell me she was ill. She was like, I'm really sorry, but you owe me £200. I was like, oh my God, thank God it's only that. But I thought it was really interesting that she felt so embarrassed and so stressed by asking me, and how that would make me feel, and kind of discussing money, because I just think it's still a topic that makes people feel very uneasy. So I find it quite refreshing to talk about it with strangers rather than people I know, where it feels a bit of a no-go area.
You've broken the mic. You can't break my back. Do you know what? That's exactly what my kids do. They break everything. So we were invited to open the stock exchange last Monday to start kind of a week of celebrations for International Women's Day, which was, for someone since they were an early teenager has dreamt about the market. Huge honour, huge honour. was very cool. It was amazing. It was, I always thought that maybe I might get to like sneak in with someone one day to do it. Like, might be able to go, hey, can I come? I hear you're doing it. And I'd be like in some picture in the back going, that's me. Yeah. I didn't ever think it would be me doing it. There isn't a bell. There used to be a bell. There's no open outcry market. There's only one left for the metals exchange. It's in their lobby. It's on the balcony. People are coming through the door, going to work and halted. But it's still very cool. You get given this plaque and you put it onto this other screen and it starts. I'm pretty sure though if you don't put the plaque there, it will still open. I don't think they leave it to chance. It was a very emotional thing. We had kind of 50 guests from across the city to invite you, but you were on holiday. And the new CEO of the stock exchange, was the first time he'd done it, so he came as well. It was really great, and then you kind of wait. There's a big fanfare, literally. They play out this music, and then they kind of whirl this screen of all the stocks coming up. And is it going to be green? Is it going to be red? Are the markets up or down? It was green, so it was all really great. But last week again, it was International Women's Day, and so on the Friday, I do the BBC paper review on the briefing once a month. It's a very early start. It's 4 a.m. pick up. But last week I decided I kind of almost a bet with my co-founder who said, I dare you to wear this T-shirt, which said, a mother's place is in the boardroom. And I thought, oh God, shall I do it? And also because it's like, these kind of T-shirts, they're not very flattering. I've got mummy tummy to hide. It all sticks in the wrong places, makes my arms look massive. I was like, oh. So I put a top in my bag. I went in. There's hardly anyone there at the BBC. And I said, oh, I opened my coat. I said, do you mind if I wear this? And then there's like a look of shock from the producer lady who was like, I could see that she loved the idea. She's a mother herself. She's like, I need to go and check. And there's kind of all of a sudden all these people start coming from all around. It's like where? And there's like a massive steward's inquiry about whether I'm allowed to wear this T-shirt or not. And there's like, there was lots of them who really wanted me to, and there were some who were like, oh, but we're not allowed to like promote anything, and oh, but it's not Nike, and we have footballers on and they wear theirs. And then the only objection at the end, when everyone agreed that I could wear it, was people might think she's been to the gym. I was like, hey, dude, no one thinks I've been to the gym because I don't go to the gym. So I got to wear it on TV, and it was just like, yeah, like, do it. Do you have any questions?
Yeah. Is it a good way in, or is it just?
Well, I would just say, so something like the money box one, I would say almost sign up to the app and then delete the app. So be signed up, but don't look at it. Or, I invest through platforms, and don't get me wrong, I'm a professional investor. I'm the same. I look and I panic, right? It's a very different, it's a feeling that you have that when it's your own. The best thing to do is just that. Just stop yourself doing, all those people who've like deleted Facebook because they know they're getting too much in social media. Just do that. Just leave it. And if you just remember that if you're not going to need that money, for a long time, if it's for your retirement, then it doesn't matter. If you look at the cycles, markets have 8-year cycles roughly. We've all actually lived through several market crashes. .com, the last credit crunch. There'll be something else that happens. They're known as black swan events. No one knows they're going to happen because no one knows, unless you have a cognitive diverse person who figures it out. So yeah, just don't look at it. That's it. Just delete the app. Sign up, delete. Sign up, put your money in, then leave it. Yeah.
And just to add, that's one of the reasons, that's been shown by research. There's a really good research by Warwick Business School and Barclays, and they're showing that women are actually better investors than men because we tend to trade less often, so we don't overreact to the stock markets, to the ups and downs. So yeah, I think the FCA, so the body regulated, the financial services, is saying you should invest for at least 3 years. I really believe it should be 10 years. But, once you're happy with your portfolio, just, leave it there, forget about it. Otherwise, you're going to make mistake. I mean, people are really trying to beat the market, so to buy low and sell high, but it doesn't happen.
Yeah, I think this is, when we were talking about pension stuff earlier, I think this is a challenge, especially for me personally, because I'm freelance, I'm always paranoid about not having any money in a year's time or 2 years' time. So the thought of locking money away that I can't access for years feels very unnerving, and I don't do it, even though I know deep down I probably should. So I think if you're paying off debt, not student loan debt, but debt that you're paying any interest rate on whatsoever, I wouldn't invest. I would make sure you pay your debt down first. I would always have kind of cash emergency savings, so money that you can draw on if something goes wrong. I think it's for any money that you feel you've got sort of not doing anything that you don't necessarily need now. And for lots of people that isn't going to be the case, is it? I guess you could use it for a house deposit, but not if you're not going to buy for a decade because of the risks. I suppose it would be, for anything you might want to do in 10, 20 years' time that you might not want money for, as well as retirement. Yeah,
if you go down if you have the pots, then you know that's the 10-year pot, that's the house pot, that's the emergency fund, and then you can just figure out what proportion you want to put. If you've got 25 quid to put in, think, I'll put a fiver in there, a tenner in there, a tenner in there. And things like, there are products out there, and this is not financial advice because I'm not regulated, but I luckily opened a LISA, a lifetime ISA, just before I turned 40, so, because you can't open one after that, and that's for, I believe you can check the facts with the money people, but £4,000 a year, up to £4,000 a year for your first house deposit or retirement. The government will match that by 25%. You're not going to get a return like that in the bank. You're not going to get a return, risk-free return from stock markets like that. So it's almost like, and you can break that. So you might lose the bonus from the government if you take the money out because of an emergency. But, £4,000 and then getting 1,000 for free from the government, it's like no brainer. And that's a kind of, and you don't have to put up 4,000, it could be anything up to. There are lots of products out there like ISAs, for instance, where you can break them, you can take the money out. So it's not, even investments, you can sell them, like funds, you can sell them, they trade. So I think the worry is that you've invested, it's fallen, and then you have to, that's the same as negative equity. It's a risk. But if you're aware of that, and if you're in something that's not so risky, then, because not everything is, stocks and shares tend to be, equities tend to be more volatile, whereas, bonds and things tend to be a little, there are products out there, there are investment types that are less volatile, so, but you just get less reward. So. You're a banker.
So that's my self-promo, but now we do workshop on like investing and, so the introduction to investing workshop is usually looking at what are all the platforms, what are all the products, so what's the difference between a pension, a self-invested personal pension, an ISA, stocks and shares, a lifetime ISA, investment account. And once we looked at all of these, then what type of assets, so assets are like stocks, shares, funds that you can then put onto these portfolios. But so we try to also write about it, but a very good website is called the Money Advice Service. And this one is like, it's a website from the government, and it's really, really clear, and it's explaining you all the different products. So of course you have to spend a bit of time looking at this, but basically it's, your workplace pension. I think it's, the main thing you should look into, because you're an investor through your workplace pension. And then there's all these categories of ISA, and ISA are a way for the government to help you save a bit more money, where you don't pay taxes on the income you're making. So if you are investing in shares, you don't pay income on the dividend you're receiving or on the capital gain. So if the stocks you're investing in, the stock is going higher, you sell it, then you don't pay taxes on this. So it's really trying to understand, for me, understanding the product first, and then trying to understand what can you buy with these products.
Yeah, you do that.
Yeah, we do that. Vestpod, we do introduction to investing, and we do advanced investing. I think you can do as many as these as you want, but I think how you really learn is by doing. So, personally, I've been making a lot of mistakes investing money. I invest in a lot of single stocks. So, I was seeing this company. So I always take this example of Boohoo. So don't buy, it's not advice or anything, but Boohoo, I bought the stock because I thought I know the company, I know fashion, I know it works. And I was really reading like the research reports, so all the information's out there, because that was my job at the time. And I actually lost money because, the share price went down 20%, but that taught me how to invest, how not to invest in single stock, how to look at funds. And then with all these platforms, I think the robo-advisors are really good because they give you a lot of information, training, there's some videos, so it's a lot of hand-holding through the process. So even if you have absolutely no clue of what you're doing at the beginning, your money is invested by professionals, and you learn, as when you do it, basically.
I was just going to say something about ISAs. I think lots of people automatically put their money in a cash ISA, but there's a thing called the personal savings allowance now. So the benefit of an ISA is that any interest you earn on an ISA is tax-free. Usually you have to pay income tax on money that you earn in savings and investments. But the personal savings allowance is now an amount of money you can earn in interest before you have to pay tax. And it's really quite big. So it's £1,000 for basic rate taxpayers and £500 for high rate taxpayers. And you think about how much money you've got to have in a bank account paying, like an ISA paying 1% in order to earn £1,000 or £500 in interest. It's massive. So actually the kind of tax benefits of saving into a normal cash ISA are potentially not relevant for lots of people now. So I think it's also worth looking at different cash savings accounts, like maybe a regular saver where you earn a bit more interest, but you can only save a certain amount of money into it. Stocks and shares ISAs are slightly different because you will be paying tax on maybe dividends or capital gains, but you also get tax-free allowances for those things as well. So I think it depends how much money you're wanting to put away. The exception is Help to Buy ISA and Lifetime ISA we were talking about, which are two savings accounts which can help you save for your first property. And if you're saving for a property, I would always consider one of them. The downside is they've got a cap on how much the value of the property you buy can be. I think it's I think it's about 450,000. Yeah. I just think it's worth mentioning about ISAs because I think people automatically opt for an ISA, but sometimes the interest rates on ISAs now are quite crap. So, yeah. Yeah, exactly. Who is this employer? Is it 16?
Thank you. You've got good financial help.
Yeah. I think if you're getting any money from your employer, and you'll be getting tax relief, which is really generous on pensions. Essentially, the government is giving you money in order to lock money away for the future so they don't have to look after you. I think it's foolish to give it up, I think, because it is free money. I think it's more challenging if you don't have an employer contribution. A lot of people who are self-employed ask me why on earth you'd bother to have a pension if you're self-employed, but it's that tax advantage again. It's basically free money that you're getting if you save. So I would always say you should stay in a pension. It's hard though, isn't it? Because there's all these like different things that we're supposed to be saving for the future, and so and housing is a big one.
Yeah, it's that. I think having those pots. I suppose from a absolute point of view, if you can't make ends meet, then it's essential to get the priorities right. But if it's the difference between a night out and your pension and your house pot, I'd give up that night out, because at the end of the day, the pension, the matching, that's a no-brainer. If you're lots of people don't go up. If your pension, if your employer says they'll match you or double what you put in up to a certain percentage, go up to that percent. Don't go higher. You don't have to do that, but get that free money, because that's a benefit in kind. That is your salary in effect, and they're hoping you don't do that because they want the tick in the box from the government for doing it. But you should take that. But I would, if you can cut corners elsewhere, make your lunch, do the rest of it, then the compounding you'll get over 20 years. So for people who don't understand what compounding is, when you have that £100 and you maybe earn £10 interest on it, the next year you'll earn interest on £110, and that's how you grow your money. So compounding is extremely powerful. And sometimes if you look at these charts, I love a spreadsheet. But if you look at the charts, it's really powerful to see how much from just a little acorn you can grow a giant oak. And then you can see over 20 years what you've done. So I would say, for those people, just say, look, if you can stretch it, do both. Because the house is a good thing, but often what will happen is people will go and buy the house or put the deposit down, and they won't go back to putting into their pension, because there'll always be something. There'll always be something in the house that needs fixing, or a cushion, or something that you're going to spend on, which actually, for the rainy day, because like you say, you don't know. The state pension is just going to go down further and further. The age is going to go up. I mean, you're in education. You know what a mess the funding situation is there. It's a scary situation. So we have to all start looking after ourselves, because you don't know what's going to happen.